Hi everyone, Jackie Zerbe here with TotalMortgage.ca, chatting with Christine Kopr from Sotheby's Realty.
Hey everyone. Hey Jackie. Thanks so much for having me today. I really look forward to connecting with you and hearing what you have to share for our following.
Likewise, let's dig into it. Today, the Bank of Canada reduced their overnight lending rate for the seventh time in a row. That means that prime will be decreasing from 5.2% down to 4.95%. So that is going to affect anybody with a variable rate mortgage or a line of credit. We're all breathing a sigh of relief. If you have a fixed rate mortgage, your payment will remain unchanged because today's announcement only impacts the prime interest rate.
Because the Bank of Canada rate is what influences variable interest rate mortgages, whereas the bond market impacts your fixed rate mortgages. And if you're in a fixed product, you're fixed for the length of that term. So it doesn't matter what's happening in the market, like right now. Your payment doesn't change until you renew. And we will talk about the bond market shortly. You'll see changes again for anyone with a variable rate mortgage. And sorry, you just talked about whether you have a fixed payment type or a variable payment. Is that right?
Yes.
We just
So
talked
there's two
about that.
kinds there's two kinds of variable rate mortgages in Canada. One is called an adjustable rate mortgage. So as prime fluctuates, your payment will fluctuate as well. It will adjust as prime goes up and down, so your payment will go up and down. So if you have an adjustable rate mortgage, your payment is going to decrease after today's announcement. The other kind of variable rate mortgage is a static variable rate. So your payment will actually stay the same. However, more of your payment will go towards principal and less towards interest, which means you'll be paying off your mortgage faster, which is welcome news to anybody.
And of course, anyone with a line of credit, like a home equity line of credit, is going to benefit also from either lower payments or lower interest on those lines of credit, right?
That's right. That's right. So, what's also great is that now, for the first time in a long time, variable rate mortgages are at a rate that's lower than where fixed rates have been. So, as an example, today, if you had an insured mortgage, that means your down payment is less than 20%. You could potentially get a variable rate at prime minus 0.95. So, you'd be sitting at an interest rate of 4%. If
Okay.
you had a conventional mortgage or a conventional insurable mortgage, so you have at least 20% down payment or at least 20% equity in your home, you'd be looking at a variable rate at about prime minus 0.5 or prime minus zero point 0.6. So also nice and low in the low to mid fours, I'd say. Fixed rates right now are in the range of low fours to mid fours, depending on whether or not you're insured or conventional. And this compared to a couple years ago where interest rates were in the low to mid 6% range. So as you can see, over time, we've been gradually experiencing these lower interest rates, which is welcome news for anybody because 60% of Canadian mortgage holders are coming up for renewal in the next 2 years.
That's right. That's right. 2025 is a big rollover year, as well as 2026. However, there's a double-edged sword here. Of course, these are the positives we're talking about as to why our Bank of Canada decided to reduce the interest rate. There are obviously some concerns as well, but let's stick to the positives for right now because there are legitimate benefits. And a couple years ago when interest rates were just getting hiked up and hiked up and hiked up. I mean, that was a very scary time. Obviously, there's a lot of people who felt pain. There are people who are feeling pain, especially if they're in mortgages of their own principal residence where, on our variable rate mortgage, things, shot through the roof. Or for our rental housing providers, which are people just like you and me who've had the ability to go out there and buy secondary properties, rental properties, and provide rental housing, the much needed rental housing that we've really needed in our housing landscape. So, for a lot of people, those mortgage holders or landlords, their interest rates went through the roof. Obviously, their mortgage payments went through the roof. And in addition to other things like insurance costs, which are also, in a kind of a crisis state as well. So, anyways, now we're starting to come back down into more reasonable levels, which is more like average normal levels of interest rates, like historically, wouldn't you say, Jackie?
I would say so. I think it's reasonable to expect a normal interest rate to be in the high threes to low to mid fours. That's a normal interest rate, and we've discussed that in the past. I think a lot of people that are coming up for renewal are feeling stressed because they've had the opportunity to enjoy a super low rate for the last few years in the 2% range, but you have to remember that that's not normal. What's important to know about today's Bank of Canada announcement is that while we're very glad they decreased their overnight rate by a quarter point, they did mention that they're keeping a very close eye on the developments with respect to tariffs because those tariffs could push inflation higher. And as we know, if inflation increases, that forces the bank to increase their overnight lending rate, which then in turn makes the prime rate higher, which of course will affect our borrowing power, makes the cost of borrowing more expensive for consumers like you and me.
Right. So one of the things that is starting to show up is that there is potentially right now this short-term period of time where variable rates are now pretty much in line with fixed rates for the general consumer. Obviously, everyone's situation is unique. Okay, like let's just be clear here, to get the best, lowest rates, you have to have great credit. Usually you have to be an insured mortgage or less than 20% down, right? And it's your own home. It's not a secondary property. It's not a vacation property. It's not an investment property. And of course, whether you're T4 employed income versus self-employed income and all of those things. So please do remember in the audience here that when we talk about the best rates, it's truly for the best rate, and then it goes up from there. But generally speaking, variable and fixed sound like they're about the same. And so there's a couple of opportunities here. I know, Jackie, you were going to talk about one of them, but the other one, it sounds like with the Bank of Canada recognizing, and I think we all recognize that tariffs will be inflationary for us and for our US counterparts, all the citizens in the US, because the tariffs are going to go both ways. It's going to be inflationary for all. It's all going to hit our pockets, right? We're all going to hurt for this. That eventually interest rates can come up. So right now, if things are low and perhaps in this time of economic uncertainty, we might see one or two more rate decreases. We'll see. But that could be the end of that, right? And soon we could start to see inflationary pressures. So feels like there's some opportunities here in terms of being in touch with your mortgage broker. And Jackie, maybe you just comment more about that, like a strategy on how to play on today.
We've been seeing fixed rates come down slowly but surely over the last few months, and we've also been seeing the prime interest rate come down slowly over the last few months. Right now is a great time to revisit your existing mortgage to see if it makes sense to break your existing term. If it's at a rate that's higher than 5.2%, it might be worth your while to pay a penalty to be able to access a lower rate, and we can crunch the numbers for you to see how long it would take to recoup that penalty as well as pay off significantly more principal if you were to jump ship from your existing term. We're happy to crunch the numbers, reach out. There's no obligation to do anything. It's just a free check-in to see where you're at. It doesn't hurt. It's interesting to note that the bond market right now is extremely volatile because of the news cycle. Every half hour, there seems to be a new update with respect to tariffs, with respect to the war in Ukraine. And so lenders, we joke about this all the time, where interest rates, it's like they're moving up on a rocket ship super fast. And then when it comes time to decreasing them, it's like they're on a parachute, just floating down slowly. And that's because lenders are trying to make as much money as they can for their shareholders. So we've been seeing these fixed rates come down. And from time to time, there's rate specials that lenders will release based on bond yields coming down. Now, because bond yields are volatile because of the news cycle, those rate specials can disappear at any time. So it's worthwhile doing that exercise to see if it makes sense to break your term early because of rate specials that we have available at the moment, and also to see if you have a mortgage coming up for renewal in the next 6 months, it's worthwhile reaching out now so that you can get your ducks in a row so that we can take advantage of those rate specials as they become available, because they can be pulled at any time without notice.
Right. Okay. So two major points. One is if you're in an existing fixed rate mortgage right now and you have a lengthy time ahead of you remaining on that mortgage, more than 6 months, right? That it's worthwhile checking in because you could actually potentially lock in a much better price right now and the penalty could make some sense. I mean, based on what you're saying though, is that we could possibly also see even lower fixed rates in the midterm. So if someone's not coming up for renewal quite yet, they might be thinking, oh, maybe now's not the time. Things are going, you're betting that things are going to go lower. However, keeping in mind that this inflationary situation could rear its ugly head at any time. Like it probably would take a little bit of time, but not that much time, right? Like we already have a lowering Canadian dollar, which is inflationary, and tariffs are starting as of now. So we're probably going to see that uptick. So it's probably worthwhile getting in touch with your mortgage broker or with you, right? And seeing if
Absolutely.
you should take that 5.2 or higher rate, pay the penalty, and lock into something now because it's not just securing that lower rate, is it? It's about protecting for the future if
Absolutely.
rates start to go back up. And then what I also heard you say is that if you do have a renewal coming up in the next 6 months, variable or not, like you might be riding this variable rate down right now and you're like, oh, this is really great. I went from up here and this feels a lot better. But if you're going to be renewing soon, then what you're saying is, hey, lock in now because you guys have noticed some specials that like show up for a day or two and then they disappear. Can you lock, like, if something like that shows up for someone, can you lock that down and then hold it?
We can hold rates for up to 4 months. So I say when your mortgage is coming up for renewal in the next 6 months to reach out because life is busy. People have jobs on the go and taking kids to activities. When we submit rate holds to lenders, we submit a full application including all of your documents. So when I say reach out now for your mortgage that's coming up in August or September, it's because I know it's going to take you some time to get your job letter and your pay stub, your property tax notice in between shuffling the kids to and from activities and meeting your work deadlines. So we hold rates for 4 months. Some of these specials are only valid for 45 days. Some of them are for 4 months. So it's important to get your ducks in a row. And especially now during this volatile period, because today we're enjoying low rates, but these might not be here this time 4 weeks from now.
Right. Okay. So very good point. So some of these specials, I hear you say, you actually can't even carry them for 4 months. Some of them are just 45-day specials because they're like, how low can you go fighting? Like things are not looking good. And so banks are probably trying to like, get that market share, right? And like you were saying, part of the banks, like one of the reasons why they don't lower the rates, like not only do they need to, are they accountable to their shareholders to generate profits, but with volatility, how do you like, why would you lower your rate if it could just like bounce back up the next day, right? So it's a tough game. I think everybody's in a tough seat because everybody needs to stay profitable to stay in business. And by no means am I suggesting that the banks aren't profitable right now, but they need to do their thing and have the ability to do that. Okay, well, this is really great. I think interesting. It sounds like a very good time. Like we're finally celebrating what we call lower rates. I know it's not 2%, 2.5, 1.8, but I remember when rates, like if we could get rates at 3%, I always felt like a winner because, they say that inflation is technically 3%. Well, we all know that's not true. And so anytime that you can get a rate lower than inflation, not that it's free money, but it's cheaper money because it's cheaper than the rate of inflation because your debt is also getting inflated away. Each dollar is worth less tomorrow than it is today, right? Being in these low fours, and I heard the other day, I don't know if you've come across this, I heard somebody getting a rate somewhere around 3.89, but again, in one of these like very cherry moments. Have you seen anything like that yet or heard talk?
There are a couple lenders offering a super discounted rate around 3.89 and 3.99,
Yeah.
but those particular mortgages have very tight regulations. For example, you're not able to refinance that mortgage. So if in the future you wanted to tap into equity to do renovations or debt consolidation or make investments, you wouldn't be able to. You'd have to sell that property in order to get out of that mortgage. So very restrictive.
Cool.
So this,
Like, what
yeah.
about like, do you have to wait till the end when it renews? Are you stuck forever in that? Like, how do you, are
You're
you,
stuck with that mortgage until the term matures.
okay,
So you have to, as a client, decide what you value. Would you like a little bit more flexibility with a marginally higher interest rate so that you've got more options down the line? Because nobody can predict the future. You don't know what's going to
absolutely.
happen next week or next month or in a couple years. So, yeah, there are some lenders that are offering slightly lower rates. In my personal opinion, I would never put a client or recommend that a client puts themselves into a restrictive term like that because you're asking for trouble down the line. That's
Yeah.
my
Well,
personal opinion.
I mean,
If the
it's really up to the client, right? But like,
client,
but I hear what you're saying because really, if we're talking about, we're on the cusp of a recession. Let's face it, we're all talking about, or the talking heads are talking about us going into a recession. The economy is going to be impacted with these tariffs if this stuff isn't cleaned up somehow, which means a recession means that there is less jobs. And if there's less jobs, it means you could lose your job, right? So right now you're thinking life is good. I've got a great job. Everything's fabulous. And I'm going to be like really focused on like getting this great rate. But what happens when things turn around? And what if you lose your job 2 years from now and you literally do need to sell your house, right? Or you need to borrow some money because you don't want to sell your house and you want to tap into your equity or something, a medical emergency or anything like that. You have zero access to it. Like, what are the penalties on a product like that? Or they're just
Some
like,
of, yeah, some of the penalties on some of those products are significantly higher than if you were to take a standard term with a regular lender. So you have to be able to read the fine print and understand exactly what you're getting into. If it's that super low rate, no frills, very restrictive term that you want.
right.
So
So you have to look at the interest rate, but then you have to look at the conditions and the terms of the contract for that mortgage. Can you share a story of a client who may have taken a product like that in the past and then maybe had some kind of an outcome, good or bad? I don't know, just as people can understand the context of like, oh, they could have had this, but they
yes.
chose that. And then this was this is a way of seeing what could actually happen.
Yes, I had a client come across my desk where they were in one of these mortgages that was a no frills, super low rate, and they didn't realize it was a no frills mortgage. The broker that helped secure that product for them never advised them of the fine print. And when they were referred to me, they wanted to access equity in their home so that they could raise the down payment to purchase an investment property. So they were trying to use their principal residence to create wealth. And when I alerted them to the fact that they couldn't break their existing term, they were devastated because now they were handcuffed to that term for the next 3 years. So they had to wait for 3 years before that original term matured, before they could move to a different lender and then access equity. So really, really restrictive. And that cost them thousands of dollars because in those 3 years, property values increased. So instead of them being able to purchase an investment property at a certain price, now that price of that property was significantly higher. And also, interest rates were significantly higher when they were ready to pull the trigger.
Right. So in that time, maybe rates were way lower. They couldn't do what you're talking about. Like, hey, if you've got 5.2% right now or higher, call me. We should do the math and just double check that there's no better option for you because, rates are a percent lower that you can't even take advantage of that, right? Because you're locked in
Exactly.
this really super restrictive product.
Exactly.
Right.
And you have to look at those products. The interest rate is slightly lower, but it's not that much lower. It might be 0.1 or 0.2% lower. So is it really worth your while pigeonholing yourself into a situation that you can't get out of down the line?
Yeah. Like, what is that on a monthly basis?
Yeah,
If
exactly.
a quarter point's only $15 a month on every 100,000, what is that like?
Exactly.
Minuscule
Exactly.
change, right? So it's like there, it's insurance products, right? Like, oh, you get
Yeah.
lowest rate, but at the, there's a tax, so to speak.
Yeah. Yeah. The
Um,
opposite, it's short-term gain for long-term pain, not the other way around, right?
Right, exactly, exactly. Well, thank you so much. Well, Jackie, I think this is really great. Awesome that you pointed this out. Interesting to see that there's almost a full 1% discount on the variable rate right now, which like when's the last time we saw discounts at this level?
You know what? There's not very many lenders offering that kind of a discount.
Okay,
And to be clear, that's only if you have less than 20% down.
right.
So you have an insured mortgage. Now, it's interesting to note that as prime continues to decrease, you're going to see those discounts beneath prime on variable rate mortgages shrink as well because
Okay.
lenders do not want to offer these deep discounts on an already low prime interest rate. So if you think, oh, I'm just going to wait until closer to my renewal because I think prime's going to come down more, you might not get access to the same variable rate mortgage as somebody who's on the ball today.
Got it.
So
Hey,
don't
that's a
wait.
really, really good tip. So these discounts may disappear if rates continue to go down a little bit more, which I think we're probably all assuming is going to happen here over the next, like maybe one or two more interest rate announcements. And it sounds like this is really applicable to maybe your first time home buyer, right? People who are just trying to get in the market. They don't have that full 20% down. And remember, the cap for the purchase price for your mortgages recently, as of December 15th, went from $1 million price cap to $1.5 million. So if anybody's thinking about going from a condo to a townhouse and making that transition, as long as the purchase price remains under $1.5 million, you can do less than 20% down. So you're not hamstrung by that down payment, which tends to be the major barrier for individuals getting into the market or, making the move up into that higher price range. So just make sure that you're aware of that in that marketplace. And of course, then you may be able to take advantage of these kind of deeper discounts in this variable rate environment right now, which there's nothing to stop these people from securing a variable rate
Right.
product right now. And then 2 or 3 months from now, when we think, or 6 months from now, or whenever, if inflation does start to come back because of our low Canadian dollar, when we have to buy US goods, we have to pay that awful, that exchange, which makes it more expensive, which makes it inflationary. But then also with the tariffs on top of that makes it extra expensive, right? So, at some point in time, we're anticipating we're going to see inflation come up. And when you start to see that or you feel that, then that's the time to lock in, right? Like when you're in a variable, you just lock in and then you're protected for 5 years if you want to sleep at night.
Exactly. The
Awesome.
variable is going to offer you a little bit more flexibility for sure. So, Christine, if people want to reach out to you to see what your current thoughts are on the real estate market, what's the best way for them to reach you?
You can reach me on Instagram at Christine Kopr _ Vancouver Realtor, all one word. My last name is spelled Kopr, so that's always a little bit tricky for people. I am missing an E or a vowel in there. Or you can email me at ckopr@sothebysrealty.ca.
Amazing. Always a pleasure chatting with you, Christine.
Same here. Can't wait to do this again.